So buying points. So when you get a mortgage, you may hear of this periodically where you can buy points. And now what is buying points? So buying points is when you are paying an upfront cost on your loan, a one-time cost, usually a percentage of the loan amount. So that's why it's called points. It's a percentage. So like 1 point is 1% of your loan amount in exchange for a lower interest rate. So you're basically kind of prepaying interest in a way, which could be good, it could be bad. It really depends on your situation, and it depends on how much points you're buying and how low the rate is going in exchange for that upfront cost. So to understand the landscape of buying points, you kind of have to understand how mortgage lending works when it comes to interest rates. So mortgage lenders don't just necessarily have one rate. Sometimes they can, depending on the program, but by and large, there's a range of interest rates. It's called a rate sheet. So you can have maybe a 4% rate, a 5% rate, or a 6% rate. Now, those are all different interest rates, so obviously you would take the 4% rate. So now think if you're on the other side of the equation. So you're not the one taking out the debt, think if you're the one collecting the debt. So you're the one that's lending the money out to the person to purchase the home, and you're collecting, let's say, 5% per year in interest. So if you're on that side of the table, obviously the higher the interest rate that the customer pays, the more money that the person who lent the money out to them makes. So it makes sense for them to have a higher rate. So how does buying points fit into that equation? Well, really, if you have a range of interest rates, depending on where the market is, buying points is a way to kind of help make them all sort of equal. So let's say, for example, a 5% rate today had no points, so there's no upfront cost, and so you get a 5% rate. I don't charge you anything upfront for that rate. You just pay 5% of the balance per year, and then that's how much it costs to secure the funds that you're borrowing to buy the house. But let's say somebody else gets a 4% rate. Well, how do you make them kind of equal if you have this range of interest rates? So the further you go down in rate, somebody with a 4% rate, they're paying 4% per year now to that end investor, whoever holds the mortgage bond. Well, I need some upfront cost there to kind of help make that equal to the person that's paying 5%, because I'm making less on the person that's paying 4% than I am the person that's paying 5%. So 4% may be something like, $3,000 upfront, one-time fee, which is buying points. You're buying down from 5 to 4, and then 4% annually. So you're kind of prepaying interest in a way. Now, just like you can buy the rate down, the opposite of that is what's called a lender credit, where if somebody else says, I'll pay 6%, well, we might not need to charge them anything. You don't need to buy the rate down like you do to get from 5 to 4. In fact, we may actually go the opposite way. We may say, well, you could actually take a lender credit of $2,000 or however much it may be. Now, you're paying a higher interest rate, so sometimes that's a benefit, sometimes it's not. Just like buying points can be a benefit, and sometimes it's not. But by and large, really buying points is a way to just kind of make that range of interest rates relatively equal in some cases, so that one situation isn't a lower rate of return to the lender, and another one is a higher rate of return, and there's no parity there. There's no way for that person who's paying less. Obviously, they're not going to lend the money less if somebody else is willing to pay more. So buying points is a good way to kind of level that playing field for interest rates. So now, how much do points cost? So points is a percentage of your loan amount. And it's not necessarily, points is kind of confusing in a way because it sort of insinuates that like 1 point will lower your interest rate by 1 point by 1%. It really doesn't. So like a point is 1% of your loan amount might be like 0.25% in interest rate. So you might go from 5 to 4.75, for example, in exchange for, if you're financing $200,000, 1% of that is $2,000. So points isn't equate. You're not buying the actual rate down. You're paying a percentage of your loan amount in exchange to buy the rate down. So when should you buy points? So that is really left up to interpretation. It depends on how long you're going to be in the mortgage. It depends on how much the points cost, and it depends on what you're getting back for the points. So for example, if you have a 5% rate versus a 4% rate, let's say that's $100 per month difference in your mortgage payment. Meaning that if you're going to save $1,200 a year by buying the rate down, let's say that cost $5,000. Well, it'll take you 4.5 years at the lower interest rate before you have saved back the money that you spent up front to buy the rate down. So you've got a lower interest rate, you're saving $100 a month, but you paid $5,000 to get that lower interest rate. Well, you're paying this money up front, but each month you're saving $100. Now, after about 4.5 years or so, you've saved back your $5,000, and every payment that you make after that is basically just a net gain to you. So that's a good thing. So you might think, well, then why not buy points if I have the money to buy the rate down? Because sometimes what people may forget is you might not be in the loan that long. So you may not be in the loan for 5, 10, 15 years, depending on what we call the break-even point, which is how long does it take me to make the money back. You may sell the home, you may refinance to pull cash out, interest rates may drop, and you want to refinance just to get a lower interest rate and save money on the mortgage. So buying points is a scenario where you're definitely spending money up front. Definitely going to spend, however much that was, maybe $5,000 in this example. And over time, you're going to save. So you're definitely spending money. You might save it back, provided that you're in the loan long enough. So you kind of lose some flexibility there. So you've already spent the money, you can't unspend it. And now to make that worth your while, you have to stay in the loan long enough to save it back and then get some type of gain on top of that. Versus the opposite, which is not buying points. And in that scenario, you're definitely saving money now. You may spend more money over time if you stay in the mortgage, but it really depends on how long you're in the loan. So if rates are low and you don't think you're ever going to sell or refinance the mortgage, then maybe you should consider buying points because it will probably save you money over the life of the loan, however long you're in the mortgage. But most people don't stay in their mortgage as long as you think. I believe the average is like 7 years or so. So for a lot of people, they pay this upfront cost, they lose the flexibility of if rates drop and you want to refinance, it becomes a little bit more difficult because you've already spent money to buy the rate down, or they want to sell, and they had this net loss. Usually in my experience, I would say that it's better to definitely save money now and not buy points and maybe spend money over time than it is to definitely spend money now and maybe save it back over time. You could look back on that in 15 years, you're still in the mortgage and you think, well, should have bought points. I'm old and gray now and I'm still in the loan and didn't think I would be here that long. But the flip side of that is you sell the house in a couple of years or you refinance and you go, oh, I spent $5,000, I saved $3,000 back in interest, yeah, but it was a net loss of $2,000. So usually I say try to avoid buying points, certain exceptions to that. And it does make sense for some people depending on where interest rates are and how much they're getting back for it. But usually if you can keep your loan costs down by any means, it's probably a good idea. And again, you might think 10 years down the road, well, I should have done that, but I would rather look back and say I should have spent more money than I shouldn't have spent that money. So usually that's just my take on it.